Hey, I'm Adam Jusko from ProudMoney.com, and in this video we're going to talk about what the difference is between your credit card statement balance and your credit card current balance. If you pay your bills online, you probably see both of those and you might get confused sometimes, and understandably so. But before we talk about that, I would ask you to please subscribe to our YouTube channel if you have not already, and if you have already, I thank you for doing so. So we're going to talk about the difference between the statement balance and the current balance. If you pay online in particular, this is something that can confuse you back in the old days when everybody just got paper bills and you sent in all of your payments. This really didn't come up because you got what is essentially the statement balance. You got a bill, it told you how much you had to pay, and you sent it in. You didn't necessarily know what the current balance was. We'll talk about that in a second, because online you see both of them, and that is why it leads to confusion. And don't feel bad if you're sort of new to credit cards and you don't understand, you think you're not figuring it out correctly or whatever. I just paid some bill this morning and I still have to stop myself and say, wait, which one of these do I have to pay if I want to avoid interest? And so that is, probably the key here is you want to know what those two things mean, because, if you are handling your credit cards correctly, you want to pay off your complete balance every month. And you want to understand, obviously, which one of those is your complete balance. So here is the answer, or at least the important part of the answer if you want to avoid interest charges, and that is the statement balance is the amount that you must pay in full by the due date if you want to avoid paying interest charges. So if you pay it all off, you're not going to pay any interest on that. And if you pay off that statement date, there's going to be no interest. If you don't pay it all off, the amount that is the statement date, then you are obviously going to pay interest. So that's really the most important piece here. Pay the statement balance by the date and you won't pay interest. So, that said, let's take a step back and I'll sort of give you the full picture of what this means. So when you get a credit card, oftentimes you use it every day or maybe every couple of days. It sort of becomes a regular part of your life. It's not like you, make a purchase and then you get billed and then you have to pay that bill, and then every single purchase you're getting a new bill, right? It just kind of keeps running. And so the way it works with the credit card companies is they basically create what is called a billing period. And that is just, two dates. There's a beginning date and an end date, and that is the billing period. So, the clock kind of starts running here, and then when you get to the end date, that is where they cut it off. And actually, some people will call that the cut date or the statement date. That is sort of, just a... in some ways, it's sort of random. It used to be sort of 30 days was a billing period. Now, more often, it is 25 days. So when you get to the end of that 25-day period, they cut it off. Everything that you charged during that previous 25 days is then billed to you. Again, in the old days when everybody got paper bills, you then got a bill for the amount of, whatever you charged during that 25-day or 30-day period, back then. Now, when so many things are online, you might get an email that tells you what your bill is, but it doesn't necessarily, have all that same information, or it's not as obvious. So you go to pay your bill online, and then when you get there, you're going to see there is the statement balance, and then there's the current balance. And of course, to confuse you more, they're going to ask you which one that you want to pay, right? So what you should do is look at the statement balance, like I said, and that is the thing that you should pay if you want to avoid paying interest. But of course, when that billing period ended, for most of us, we're going to keep using our credit card, right? So you're going to have that cutoff date that they use as sort of an arbitrary cutoff to bill you, but you're going to continue to use your card, which means you're going to have more charges than just those charges that were on your bill, right? So you've got money, you've continued to use the card, you've added more to your balance, but that part is not due yet. You don't have to pay it yet. So essentially what that means is, when you get online and you see a statement balance and you see the current balance is the statement balance plus any new charges you've made since that cutoff date. So usually, if you've continued to use the card, if you've continued to use the card every time, the current balance is going to be bigger than the statement balance. If for whatever reason you haven't used the card since the last bill was made, then the statement balance and the current balance could be the same. But that is pretty much how it works. Now, just to give you a quick example, I actually paid a credit card bill this morning, and like I said, had a little confusion, had to look at the current balance and the statement balance and think to myself, what do I have to do here? Which is part of the reason I'm making this video. So the billing period was August 11th through September 12th. On September 13th, a bill was cut and I got a statement, and I actually still get some of my statements in the mail. So I actually got this one in the mail, but I got it online at the same time. And I think it told me my bill was due on October 13th. So I had a bill for about $680. That was the statement balance, the charges that I had made during that period. And by the way, if you have a previous balance and you've been paying interest, those charges that you make during that billing period are going to be added on to whatever your previous balance was. But since I always pay off my everything in full each month, and you should too, hopefully you're only paying what was during that billing period. So anyway, I had about $680 in charges there that I had to pay. But when I go into the system online, I see a statement balance of $680, but then I see a current balance of about $850. So the $680 is what I actually have to pay by the due date in order to avoid the interest charges. When I make that payment, that gets subtracted from what I, the current balance that I have on the card. And so if I had a current balance of $850, you take away $680, that means my balance has now gone down to $170. And that $170 is the beginning of what I am going to owe on my next bill. So that would be, the $170 would be what becomes my current balance. And then I have paid off my statement balance from that prior month. So hopefully that makes sense. If you have any questions, please put them in the comments below. Otherwise, thank you for watching, and please go to proudmoney.com where we talk about other personal finance issues and do credit card reviews and have all sorts of other fun stuff going on as well.